Hello, everyone. Welcome to today's webinar. This is part 5 of the groundbreaking complimentary 8-part webinar course that is designed to support financial advisors as they navigate this new world of blockchain, cryptocurrencies, and digital asset investment opportunities. I'm your moderator, Dara Albright, co-founder of D-Wealth Education, a new educational platform dedicated to providing incentivized learning to financial professionals, business executives, and modern-day investors. Today's session will focus on ways to safely invest in digital assets. Our distinguished presenters today are John Sarson and Jahan Jamali, co-founders of Sarson Funds. Jahan, as many of you already know from our previous sessions, is a former intelligence officer and leading expert on emerging technologies, global risk management, and international relations, as well as a renowned cryptocurrency educator. John is Sarson Funds' CEO and is a leading cryptocurrency and digital asset investment management expert with a distinguished career in financial services. Both are routinely sought by the media to talk about how blockchain is shaping finance. Now, before I hand over the mic, just let me take care of just a few housekeeping items. This webinar, so you all know, will last 1 hour. There will be 50 minutes, 50, of presentation time and 10 minutes of Q&A at the end. We do reserve the Q&A for those last 10 minutes, but you're welcome to add any questions that you have as you're following along in the presentation in the public chat box. Feel free to add them as they come to you. Just know we won't really be answering them till the very end. These live webinars are interactive, so feel free to use the public chat to weigh in on the discussions. And also, if you can, please include a question mark with your question, because that'll help us distinguish what's a question from a comment. But important, I just want to make sure everyone knows the chat is for weighing in on the discussion only, so no advertisements or anything like that. As a reminder to everyone, Investments and Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. And regardless of whether one has those certifications or not, everyone who completes the entire 8-part program will earn a level 1 crypto advisor certification from Sarson Funds, demonstrating cryptocurrency and digital asset expertise. The completion certificate will be issued at the end of the course as a non-fungible token, an NFT, which I'm sure you've been hearing a lot about that in the news. The NFT issued certification really is a truly groundbreaking, and I really do encourage everyone to learn more about it when you get the chance. And in fact, if you look in the handout section here, I put a link to a recent podcast where Jahan discusses the Sarson NFT issued certification, as well as how NFTs may play a role in transforming education and accreditations at large in the future. With that, we're going to jump in, and I'm going to hand the mic over to you, Jahan.
Well, thank you very much, Dara. I'd like to thank D-Wealth and all our supporters here, and welcome folks back who've been in our previous sessions. It's great to see everybody again, and to also give a welcome to those that might be joining us for the first time. This is session 5, and we're going to talk about safely and securely investing in cryptocurrency. And I'm really excited for this session because we've certainly seen a lot of activity here in the cryptocurrency space. And while everybody's getting excited, this is the perfect time to really go over how to do this safely and securely. And I'm thrilled to be joined by the eponymous John Sarson, my partner and the CEO of Sarson Funds. John and I, to give you a little bit of background, John and I have known each other for well over 2 decades. Ever since we were in high school, and then we reconvened in our professional lives, where John was able to take his experience from Wall Street and his experience as a fiduciary, as an RIA himself, and we were able to create what has become Sarson Funds, and it's been an exciting journey. John, thanks for joining us today.
Thank you, Jahan. It's so nice to be on the program with you. Jahan is right. We've been close friends since the age of, what is that, 15 maybe?
14, well, maybe 15 for you. You're a little older than me.
I remember distinctly Jahan being the strongest guy I knew freshman year because he could bench press 2 plates on each side of the bar, which was really impressive.
Well, thank you very much. I'm about to turn red before we get started here. But we're happy to have you, John, and I know you've given this presentation or parts of it before to the Money Show, and this is the safety and security aspect of cryptocurrency and digital asset investing. I know is very close to your heart, so I'm thrilled to have you. And what I want to do before I turn it over to have you go through some of the components of our course today is let's give a quick overview to everybody. So this is what we're going to learn here in session 5. And if you guys have been on my previous sessions before, you know that we take a very top-down approach to understanding digital assets. And we like to talk about the high-level elements and then drill down into them a little bit further along so that everybody has a contextual and conceptual understanding of digital assets, because it is, depending on your degree of knowledge, for everybody here, this is a brand new space. And everybody has a lot to learn, even me. And we're really excited to try to walk everybody through in a pace that they can feel comfortable with. And for those that are a bit more knowledgeable, to help fill some of the gaps that you might not have realized you had. So what we're going to talk about today is the investment risk itself in cryptocurrency. We're going to identify some of them, and we're going to talk about ways in which you can manage that risk. We're going to go into a bit more detail on exchanges. And exchanges are really important because they come in a variety of flavors here in the cryptocurrency space. And we talked about decentralized exchanges when we talked in our investment strategies session, a session or two ago. But we're going to talk about US-based exchanges and the pros and cons of cryptocurrency exchanges and your considerations of risk. We talked about ICOs in the last session too, initial coin offerings. We're going to go into a little bit more detail of the risks involved when it comes to understanding how to invest or consider an investment in an initial coin offering. We're also going to talk about diversification. And we're going to talk about diversification, not so much in a way that we did previously in our investment strategy conversation. We're going to talk about it as a way to mitigate risk and why diversification in a digital asset portfolio is so important in your risk strategy. We're going to talk about privacy, and we're going to talk about that a little bit in depth than we have in the previous. So we talk about it a lot in some of our earlier sessions of the importance of making sure that you're taking the right security precautions, procedures, and putting a protocol in for yourself so that you can translate those best practices to your clients. And we're going to talk a bit more in depth about how to keep these investments private and how to keep your accounts secure. We're also going to talk about insurance. This is something that a lot of folks might not have known was available. And I know we've got a polling question up in here that, please feel free to chime in on the poll, is if you were aware that digital asset transactions can be insured. We're going to talk a bit more about that towards the end of our program today. As I'm seeing already, this is something that's probably new for folks, and it's something that I know in our firm that we're very well versed in. So I'm excited to be able to share that knowledge with you, and I know John is too. So without further ado, let's roll into our presentation today, and let's talk about how do we make investing in cryptocurrency safe, and how do we make it secure so that you can take those best practices and pass those through to your clients. So John, without any further ado, I'm going to turn it over to you.
Awesome. Thank you, buddy. It's a pleasure to be on the call today. As Jahan and Dara mentioned, I do have a background in finance, and I spent 15 years as a wholesaler for different mutual fund companies, Lord Abbett, Dreyfus, and later Guggenheim. And then I left that role at age 34, and I started an RIA, a quantitative RIA that focused on trend following and low-cost ETFs. And that RIA has morphed over the course of the past 6 years into a specialty firm that focuses on digital assets. And what became apparent to me was, through my own investing in Bitcoin, was that I was putting in maybe like $1,000, and then when it would grow to $5,000, I would take out $4,000. And the reason I wasn't putting in more money than that is because I didn't really understand the risks associated with the investment enough so that I could put in a sizable amount of money. And of course, I wish I had put in more money back in 2015 and 2016 into Bitcoin. But we do believe that we are still in the first half of the ballgame when it comes to digital asset adoption. And I believe that everybody on this call is still early to the game, and there's still a lot more upside in digital assets. But before any of us can put our own money in there, let alone our clients' money, we have to understand the investments and the risks associated with the investment. I have a lot of roles at Sarson Funds, but the role that I take the most seriously is the role as the Chief Risk Officer. And that's because, as many of you know that are financial advisors in the audience, your first clients and your best clients are your family members and your friends. And the number one thing we don't want to do is we don't want to lose money when we're trying to exploit an investment opportunity because we didn't understand fully what the risks were. So we'll slow down for an hour today and we'll spend time talking about risks. And hopefully all of these risks are quantifiable and things that you can get your arms around. And so therefore you can either invest more safely yourself or you can give good advice to your clients. I do understand that many firms don't have an open architecture and they don't give permission to do cryptocurrency investing on the behalf of your clients. And hopefully that'll change over time. But in the meantime, clients look to everyone on this call for financial advice on all assets, even if that asset isn't something that is warehoused at your particular place of employment. And this presentation is going to hopefully provide some of the foundational information that you need to give that good advice to your clients that I know you care very much about to make sure that they have a good outcome investing in cryptocurrency and that they avoid some of the most prolific pitfalls that have befell other investors. And so this is a great graphic of Dorothy with a Bitcoin, and we're not in Kansas anymore. And what we really mean by that is that we're outside of the purview of the consumer protections or the investor protections that have been put in place for the last 100 years in the United States. Specifically, in cryptocurrencies, you don't have FDIC insurance, nor do you have SIPC protection. And as financial professionals, I'm sure you're very familiar with both of those terms. You also have hackers that are actively looking for sloppy crypto traders, people that they can take advantage of either through phishing schemes or through other types of password compromising attacks and to steal their cryptocurrency. And the unfortunate reality is that if this happens, there's a very low recovery rate for stolen cryptocurrency. It's not like a wire that gets intercepted, at the bank where you can see where the wire went, and then the FBI can request the money back from that bank or a foreign bank. Oftentimes, this money is gone and it's offshore and it's highly untraceable. We also don't have the protection from the SEC in overseeing initial coin offerings, the same way that they would oversee an IPO process. For those of you that have been involved in IPOs, there's a lot of regulations that go on. There's quiet periods, there's different announcements that have to be made or disclosures that have to be made as far as conflicts of interest and revenue projections. And there's a process there in place designed to protect investors, none of which exists in the cryptocurrency market currently. We believe at our firm, Sarson Funds, that the industry will move towards a regular way type financial structure. And in fact, we participate in an industry organization called the Association for Digital Asset Markets, or the ATOM for short, that basically is trying to put these best practices in place for cryptocurrency to protect investors and to help bring some of the cryptocurrency operations out of the shadows and into the light of day and under the purview of a regulatory agency or an SRO. And we continue to work towards that goal. But for the time being, those protections are not in place. Those agencies are not actively monitoring cryptocurrency offerings. And so it's very much caveat emptor, buyer beware. And buyer beware starts at, with each one of us. And we're going to talk about some of the things we can do to be aware. And of course, we don't have rating agencies like Moody's, S&P, or Fitch to rely on to give us a sense for the caliber or the quality of any specific cryptocurrency investment. Let's see, moving on. So we're going to start first talking about the exchanges that we use to buy cryptocurrencies. We have seen in cryptocurrency, a short 10-year history, a couple of very high-profile exchange failures. There was a case called Mt. Gox, where it was a very famous case in Japan, where one of the earliest cryptocurrency exchanges was hacked. Turns out all of the assets were on one person's personal computer, all of the private keys. That is 7 years ago now. The victims of that hacking event still have not been paid out their final restitutions. The good news is, for the 40% of the firm's assets that were left that have been in Bitcoin for the last 7 years, everyone's looking at huge windfalls and gains from that hacking, but we cannot hope to be so lucky when we experience an exchange hack. Sometimes an exchange hack can be problematic even though maybe all of the assets aren't gone, as is the case of the Cryptopia hack in New Zealand in 2019. And there was a hacking there and they decided to declare a bankruptcy and insolvency, and they've been illiquid ever since. So sometimes an illiquid exchange is the same thing as losing your money, because we can't get those assets back until we get through the court bankruptcy process. And so what we do at our firm to make things safer is we major in the majors and we major in the United States. We like the way that the United States bankruptcy courts work, and we think that that's our best chance for a satisfactory workout in the case of a bankruptcy. And we major in the majors. You know, the major exchanges in the United States, such as Coinbase, have a market cap of around $100 billion. They have the financial backing of companies like Goldman Sachs, and Coinbase itself, and Fidelity and BlackRock are all investors in Coinbase. And so if they have a hacking event and they lose $100 million or $1 billion, you know, with their enterprise value of 100 billion, it's fairly safe to assume that they're going to patch up that hole and make investors whole rather than close their doors. And so that's some of the benefit that comes from being associated with the biggest exchange partners in the world. And luckily for us, many of them are right here in the United States. On this list that you see, Coinbase and Kraken and Gemini are all US native exchanges, and we recommend using all of them. And when I say all of them, I actually do mean all of them. You know, working with one exchange partner will give you exposure to one counterparty. And if you can diversify your assets across more than one counterparty, you create a safer environment for you in the case of an exchange becoming illiquid or insolvent. Now, there are some disadvantages to doing multiple exchanges. The disadvantages, of course, is that the application processes are a little bit onerous, and there is going to be a slightly more complicated tax scenario for you and your clients at the end of the year if you use those multiple exchanges, but it's something that we do at our firm, and we think it's well worth the extra effort. I see a poll here. How familiar are you with crypto exchanges? There's a few crypto exchanges. There's quite a few, actually. I would say as a US resident, we should be looking at US exchanges primarily. There is some safety in a US exchange. And the number one place that the safety comes from is the fact that there's less of a risk that US regulators will shut down your exchange. You know, if you have assets on a foreign exchange and US regulators tell that foreign exchange that they're not complying with US laws, and the foreign exchange says, as many have, okay, well, then we won't do business with US customers anymore. All of a sudden, you're in this weird limbo place where you have to withdraw your assets by a certain date. If you don't do that, you're kind of out of luck. And we never want to put our clients there or ourselves there, so we like to just work with nice US exchanges. Now, one of the downsides of that is that maybe you won't have access to all of the newest coins that are being launched in Asia. And this is a downside. There's no really two ways to cut that. Moving to the next slide. When we're looking at cryptocurrencies, there's a lot. There's 13,000 cryptocurrencies that have been launched so far. 13,000. That's more than there are stocks in the stock market. And many of these coins will go away. Many of these coins don't need to exist, but they're marketing projects, and people are making a lot of money. Some of them have icons of dogs, and some have cats, and some have bats and birds. Yeah, there's a lot of coins. People are literally throwing stuff against the wall to see what sticks. And occasionally something does stick, like Shiba, and it makes big headlines because of the returns are so eye-popping when it does. That's really more speculating, less investing in our opinion. And so when we're going to invest in digital assets, we want to find digital assets that have proven themselves to be worthy of our investment dollars. And one of the ways you can do that is by reaching some certain milestones that we look for. One is that you get listed on a regulated US exchange, such as the ones we mentioned earlier. Another is that you have been around for a little while. We've put down 6 months in parentheses here, but a year is great too. I think that a coin that's been around for a little while has had more time for its technology to be kind of vetted, its development team to be kind of understood, and to see like what types of development they're capable of. And then one rule of thumb that we use in our large cap portfolio is we don't invest in any cryptocurrencies until they pass the $1 billion total market cap threshold. Now, none of this is guaranteeing you're going to avoid all fraudulent coins, but one of the places where fraud is happening the most rampantly is in the ICO market, as Jahan mentioned at the start of the call. So why is this happening so rampantly? An ICO, or initial coin offering, is oftentimes preceded by a pre-sale. And a pre-sale is basically the development group or the marketing group behind a specific project going to the market and saying, hey, we're going to launch this coin and it's going to be amazing. And we're going to price it at $1, but we're going to sell it to you for 1 penny. You're going to have an immediate 100x return. This falls in the category of if something sounds too good to be true, oftentimes it is too good to be true. So what ends up happening is these projects will tell lots of people they're going to launch this coin for $1 and it's going to be fabulous and everyone's going to have a 100x return, and they collect $10 million and then they vanish, they ghost. It's called an exit scam. They just exit, and they take all the money with them. And this has been happening quite a bit. So how do we avoid this? If you do want to invest in these pre-market coins or these initial coin offerings to the public, these ICOs, well, the number one thing you need to do is understand who's launching the project. Is this a known quantity in cryptocurrency? I'll give you an example of this. Ethereum is a very big project many of you are familiar with. It's a smart contract platform. The chief technology officer at Ethereum was a gentleman named Gavin Wood. Gavin Wood was approached 3 years into the Ethereum project, and he was offered $5 million to start a new blockchain, knowing everything that he knows now about Ethereum. How would he build it differently? He took that offer and he launched an ICO called Polkadot. Polkadot is like Ethereum, only it's a little bit different. It uses a proof of stake consensus mechanism, which Ethereum still does not. It's a little bit faster. It's a little bit more secure. It's a generation 3 cryptocurrency that we like quite a bit at our shop. But this is a perfect example of like understanding the team behind an ICO. If the team behind your ICO has not done other cryptocurrency projects, consider that a major red flag and maybe walk away from that particular project. Consulting with industry experts is something that I would recommend as well. It's hard to necessarily understand if the team has what it takes if you haven't been in the weeds on cryptocurrency. So consult with an expert. Our phone lines are always open at Sarson Funds to kind of like hear people's ideas and kind of tell you the types of questions that you maybe should be answering or asking.
It should go without saying too, right, John? Consulting industry experts is not the anonymous dude on Reddit. Right. So, there's plenty of FUD out there and there's plenty of folks promoting all sorts of information, but know who you're getting it from too.
Yeah, I would say, and then that's really a good point. Everyone's an expert until stuff starts going down. And then the final point there is perhaps leave ICOs for the pros. We've been running cryptocurrency hedge funds for 5 years. We've only done 5 ICOs. So like that should give you a sense for about how often a good ICO project crosses our desk. And if you're seeing an ICO that's trying to raise money on a vision of grandeur, like maybe take it with a grain of salt and maybe pass on that one. Didn't skip, did I? No. Okay. So another thing that we want to consider is the fact that regulators have been very clear in this country as to what they're okay with and what they're not okay with. And considering that one of our overarching theses for investing in digital assets is to benefit in the growth of the digital asset world and digital assets ecosystem, then we want to make sure that we're investing in projects that aren't going to face a regulatory hurdle or roadblock in the near future. One of the easiest ways to do this is listen to what Congress says they don't like about cryptocurrencies. And what Congress doesn't like the most about cryptocurrencies is the fact that, in their opinion, they can enable money laundering and terrorist funding. You know, I lived and worked in New York. I consider myself a New Yorker at heart. And the last thing I want to do with my investment dollars is support terrorists. And for that reason, as at our firm, Sarson Funds, we won't invest in any privacy tokens. Privacy tokens are tokens that are designed to conceal the identity of their users or the recipients. And as Congress points out, these types of tokens enable money laundering and they can power the dark web. And they're not wrong. That's exactly what these tokens are being used for. But what we believe at Sarson Funds is that these tokens will have a short life here in the United States and in the West, as there's no reason to have your identity obscured from a transaction from the government unless you're trying to do something nefarious or outside of the rule of law.
So we think absolutely, John. And like we've mentioned before in our previous sessions, how Bitcoin, as we gave an example, is the most transparent payment network in human history. However, you know, I could speak to as a former intelligence officer, when you try to obfuscate origin or obfuscate destination of your funds, it's really for one of only a couple of reasons, and you know they're predominantly nefarious. Either you're trying to skirt a regulation, or you're trying to outright fund or launder or fund something criminal or outside the outside the parameters of law, or you're trying to launder funds. And you know, John's absolutely right. You know, when you're looking to build a portfolio of digital assets, you know, whether these get fully banned or capable of being banned or not, you're going to see their use cases start to dwindle and shrink and be limited to those, you know, to those areas and those use cases that fall outside the boundary of law and outside the boundary of regulation. And if the United States really, you know, if you really believe the United States is going to embrace digital assets, which we believe they will, you have to discount some of these privacy tokens as being part of that equation.
100%. You know, we're trying to get in the way of the big money coming into the space, and the big money coming into the space is notoriously risk averse when it comes to regulatory risk, but also headline risk. No one wants to be associated with a project that gets on the wrong side of law enforcement or in the regulations. And these projects, these privacy tokens, they're on the wrong side of the law in this country and in the West. And we don't need to stick around to see how this movie ends. We know how this is going to end, and we're going to avoid these types of investment as a way to make our overall portfolio safer. We'll find something else. And I said portfolio in the last sentence, and that's because a portfolio approach is very much what we recommend as far as a safe way to invest in cryptocurrency. It pains me deeply when people tell me that they bought Bitcoin and they printed out their private key and they put it in a safety deposit box and they're not going to check it for 10 years. This is, I think, a big mistake. Even though we love Bitcoin and Bitcoin has a special role in cryptocurrency that we can talk about, the reason why this is such a mistake is because, in our opinion, these are technologies. And technology, the history of technology is full of examples of creative destruction, where one technology gets replaced by a better technology. You can think of Netscape getting replaced by Yahoo, getting replaced by Google, or you can think of MySpace getting replaced by Facebook, getting replaced by something coming up soon. And like this is going to happen to cryptocurrencies as well. Bitcoin is a generation 1 cryptocurrency. Ethereum is a generation 2 cryptocurrency. Polkadot is a generation 3 cryptocurrency. I would be very surprised if in 10 years, if they each had the same relative positioning to one another in a cap weighted index like the one that we showed here. So what we want to do as a group and for our clients is encourage the investing in digital assets generally, the growth of digital assets, the growth of cryptocurrencies, and doing that in a portfolio with multiple different cryptocurrencies. This is our 10 largest cryptocurrency portfolio from last year. Doing that in a systematic way where when the market tells you that now a different cryptocurrency is providing more utility and therefore is gaining in value relative to Bitcoin, then your portfolio should adjust as well. So we think that a diversified portfolio reduces the risk of one coin really destroying your investment outcome, but it also is the right way to invest in a rapidly changing and growing sector like digital assets.
Frequency.
Yeah, so the space moves pretty quickly and there's a lot of noise. In fact, that's a reasonable segue to the next slide. But the rebalance frequency doesn't have to be overly onerous. Taking a look every month to see how the top market caps have changed positions relative to one another and then making some adjustments in your portfolio is frequent enough. You could probably get away with doing it quarterly or even once every 6 months. You just don't want to put away your favorite coin for 10 years and come back and visit it. So rebalance frequency, monthly is great, quarterly is fine, semi-annually is probably also okay. If you look 6 months ago, Bitcoin probably represented 70% market dominance. Today it's down to 45% market dominance. And so things do change somewhat rapidly, and that's only been over the course of the past 6 months. The volatility and price trends in cryptocurrency are very important. It's something that we look at closely to try to manage risk. Because cryptocurrencies are not stocks, they don't have the same contributing factors to their price performance as stocks do. They don't have earnings. They don't have to make widgets. They don't have accounts receivable that needs to be filled. Instead, they have supply and demand. And because of that, they tend to trade a lot more like commodities that are, priced based on supply and demand. And just like commodities, they respond very, very well to technical analysis. There is no CEO of Bitcoin, contrary to what Elon Musk may think, that can make a comment that will change the value proposition of Bitcoin dramatically. So just like a commodity, instead we're going to see price action that's going to be driven by supply and demand, and we highly recommend using technical analysis to limit risk. And you'll notice as you start applying technical analysis to cryptocurrencies that they follow technical analysis extremely closely. Many of the traders in the cryptocurrency markets are technical traders, which makes the technical analysis that you can do on a cryptocurrency be almost a self-fulfilling conclusion. So we do highly recommend monitoring them and using technical analysis to figure out entry and exit points in cryptocurrencies. So now we get to some of the fun part of the presentation. And it's fun because I love devices and I love technology. Jahan, I think you do too. And people do around the world. And that's one of the reasons why cryptocurrencies are so catching on so quickly in Korea and in Japan and Singapore. And it's because the cultures embrace technology. And cryptocurrencies are, a technological innovation. But with technological innovations, we have to get better at creating barriers to technological attacks. And so many of you have set up accounts and you've done two-factor identification. And we're going to talk a little bit about two-factor identification right now. Because I've had two-factor identification and it almost went terribly wrong for me when someone illegally stole my SIM card and sold my SIM card to a malicious actor. That person used my SIM card to change my Gmail account, and then they used the combination of my Gmail account and my SIM card to try to change additional accounts that were in my name. Now, the reason that they didn't get anywhere was because I had a two-factor authentication on most of my programs that was not SIM-based, nor was it email-based. So let's talk about that for a minute. What do we mean there? So sending you a text message to verify your lost password is okay. Sending you a text message and an email is slightly better, but sending you a text message, an email, and also a third factor non-SIM based means of proving your identity is much, much more secure. Many of you have already downloaded Google Authenticator. This is an app that you can put onto your phone for free that will allow you to have a method of providing a PIN number that isn't something that can be compromised in a SIM swap attack. Very, very important.
So like you have a time interval on your Google Authenticator and it's always revolving. So that's also highly secure. And just to dovetail on what John was saying earlier, especially if you're a publicly facing individual in a cryptocurrency firm, they're going to be subject to these attacks. John's been a subject of a SIM attack. I've been personally the subject of a SIM attack. But what protected us both was these types of security measures that John's walking through right now.
Yes, and so the Google Authenticator app is on your phone, and so that's pretty good because it's not your SIM card, but it's still on your phone. So if someone gets into your phone, they could potentially get into your account. I know your phones are protected with fingerprints and PIN numbers, but if someone gets into your phone and your Google Authenticator is on your phone, they could potentially get into your account. And that's when these next two devices that are featured are shown. One is the one on the far right is called a YubiKey, and a YubiKey is a air-gapped hardware device, solid-state hardware device that plugs into your machine when you want it to generate a PIN number for you. And then when you don't want it to generate a PIN number for you, it stays somewhere safe in your drawer or on your keychain. And the number one thing that makes this so secure is that no one knows that you're using this type of identification process unless you tell them in advance. And we'll talk about that in the next slide, but we don't want to tell people how we secure our portfolios or your portfolios. The item in the middle of the page here is a new wallet ID card from Arculus. John, do you want to talk a little bit about the Arculus card?
Arculus is a product from CompoSecure. CompoSecure's main line of business is they make the hardware and technology behind premium credit cards. So it's actually credit card technology that has what's called three-factor authentication. It's tied to an app with cold storage functionality right within your phone. So you need to have the phone near your card. You need to have the card with you, and you need to know what the PIN is to be able to verify a transaction. And also there's biometric reading as well through the app. So it's called three-factor authentication, and it's highly secure, and it also provides you not only with transactional capability, but cold storage capability that's backed by the technology within the CompoSecure's Arculus card. And it's, you guys can find it online. You can get Arculus.com, but both of these technologies are pretty cheap. John, how much is a YubiKey?
$50.
$50. And I think with a couple coupon codes that are out there, you can get the Arculus card for about the same. So this is not, cost prohibitive whatsoever. And, they're freely, they're available on the market, available online. If you have any reasonable amount of cryptocurrency, even if you just have a small amount, it's not a bad idea to get one of these devices. The YubiKey is used by a lot of institutions. Get familiar with it, understand and feel comfortable with it. And then you're going to feel a lot more secure as your cryptocurrency holdings hopefully grow.
Yeah, and it's not just for cryptocurrencies either. It's for Dropbox, it's for Gmail, it's for Outlook, it's for GoDaddy. We want to add another email user to our corporate account. Like, we have three-factor set up for that, because these are all different ways that scam artists get into your organization, and then they impersonate an employee and they try to do bad things. The beginning of this headline here on this slide says sterile devices. And I want to spend a minute talking about that. It's everyone's least favorite part of the presentation. But it's something that we do at Sarson Funds, and that I think that most professional firms do when it comes to cryptocurrency management. What's a sterile device? A sterile device is the machine or the phone that you use to trade cryptocurrencies and to send cryptocurrencies and to buy cryptocurrencies. And you don't use it for anything else. You don't use it for surfing the web. You don't use it for Facebook. You don't use it for email. And email is a hard one for people because we want to keep this device sterile. We don't want it to accidentally click on a malicious link and get some malicious software onto it that creates a gateway for a bad actor to get access to your cryptocurrency accounts. Remember, we are our own banks with cryptocurrency, so there is no bank there to protect you. You have to be diligent and protect yourself, or your clients have to be diligent and protect themselves. I'm going to give you a short but scary true story of something that's happening. There's currently a piece of malware on the internet that if it gets on your computer, it does nothing. It just sits there until it sees a 26-digit long number of a Bitcoin wallet address on your clipboard in Microsoft Office. Then when it recognizes that, it replaces that address with its own address. So here's the payment process that happens in Bitcoin. Oh, you want to send someone Bitcoin? You go to wherever they sent you their address, you copy it to your clipboard, you go to your wallet, you go to send, you paste it in there, you hit send. but the address has been switched out by this malware. And so you just sent the money directly to the hacker and it's gone. So you'll never know that that's happened until the money doesn't arrive. And then you'll look to see where you sent it and you'll say, how in the world did I send this money to a completely wrong address? So anytime you are doing a cryptocurrency transaction, it's important that you look at the address that was sent to you. We typically ask people to send us a screenshot, like an image showing their address as part of the image, and then pasting the address also so that we can copy it. We verify that the image shows what they pasted, and then we paste their address into our to field on our cryptocurrency transaction. We again look at it to make sure it's the same address that was in the image and that they pasted. Then we hit send. It's a small ounce of prevention to prevent a very terrible outcome, and we highly recommend that everyone take a minute when you're doing a cryptocurrency transaction to eyeball the address you're sending it to versus the address you're supposed to be sending it to, and make sure that nothing happened on your clipboard on the way there. It really does happen, and people have really lost a lot of money from that particular piece of malware. You can keep that off your devices by keeping them sterile, and we use sterile devices at Sarson Funds for all of our cryptocurrency transactions.
Yeah, and that's the trade-off too, right, John? Like, if you're going to be your own bank, you want to take that type of responsibility, which people today they want to have. You can't get lazy with security. You have to be vigilant, right? You can't take it for granted, and you need to be aware of the current threats, the emerging threats. You don't have to be paranoid, but you need to keep abreast of these things. If you're going to self-custody your cryptocurrency, if you're going to be transacting your cryptocurrency and holding it in some place outside of a professional firm, you need to be aware of these things, and any investment in these types of security devices and just the time, a slight additional time invested in doing it right can make all the difference.
That's right. An ounce of prevention is worth a pound of cure. It can make all the difference. So this is going to seem kind of silly, but we've seen so many instances of this going wrong for people. Some people have made a lot of money in cryptocurrency. And there's a natural tendency, I think, as human beings to talk about that. Talking about that makes you a target. And not just a target to a hacker coming in, but a target to a thug coming in with a gun and saying, give me your cryptocurrency, mugging you, sticking you up and taking your cryptocurrency at gunpoint. In Russia, they know better. I met some Russians when I was recently traveling, and they said that they are so concerned about people knowing how much money they've made in cryptocurrency, they won't even pay taxes on it because they're afraid the government finding out. It's kind of an interesting dynamic. I didn't know how I felt about that. So don't tell people about your cryptocurrency investing if you're doing it in a significant way and you don't want to attract unwanted attention. If you do have a lot of cryptocurrency, you may want to consider vaulting some of that through one of the exchanges, such as Coinbase. Coinbase offers a time vault. Why would they offer a time vault? This is the same exact concept as the 7-Eleven time vault that they put the daily cash register proceeds into at the start of the evening. The cash register operator cannot get to them because they can't be released until the time of whatever it's scheduled to be released at the next morning. The same thing happens with cryptocurrency. You can put your assets into a time vault, and if you want to get them out, a 3-day waiting clock starts, and then you can get them out in 3 days. This would be problematic for someone that was trying to mug you and say, give me all of your cryptocurrency. I know you have $1 million of Bitcoin. So like, I only have $10,000 in my hot wallet. The rest is in a vault. I can't get to it for 3 days. And it takes a different level of commitment, I think, from a would-be mugger to really kidnap someone for 3 days and wait that time vault out. And so it's one way you can protect your assets if you are unfortunate enough to get into that type of a situation. You can also move your assets off exchange. It's not something that we encourage people to do at Sarson Funds, candidly. I think one of the safest places for your assets is right on the exchange. These exchanges are quite profitable, trading cryptocurrencies and charging their fees. They have enormous financial backing of some of the biggest institutions in America and around the world. And they're not really in the business of stealing people's cryptocurrency balances, at least not at this moment in time. And so the assets seem very safe for me right there. Moving assets off exchange involve downloading your private keys, putting that onto a pen drive or printing it onto a piece of paper, and then having to safely and securely store that against fire and flood and loss. And that sounds more risky to me than leaving the assets right on the exchange. And so we typically recommend people leave assets on the exchange. If they have a lot of assets there, use a time vaulting and keep a low profile for the time being, because like right now there's still some lack of investor protections that have not been fully addressed when it comes to people robbing one another for their cryptocurrencies.
Yeah, and just to go on what John was saying earlier, you don't take cash out of the ATM and start waving it around in a public place. All right, you gotta, when it comes, you don't take pictures of yourself with like a bunch of bills all around you without thinking you're going to make yourself a target. So same thing with cryptocurrency, right? These same types of rules apply. So be cautious, be humble, and just understand that everything you do online, from social posting to all other types of conversations, is visible oftentimes elsewhere. So don't make yourself a target unnecessarily.
Yeah, for this audience, for this call, it probably applies less because, the SEC already has problems with financial advisors, taking a picture with a stack of money or with a Ferrari because it implies like a certain outcome on investments. And so everyone knows better than to do that kind of stuff. But, this is advice for your clients. This is advice for your client's nephew who's made $1 million in Solana. What kind of advice can you give them? This kind of advice. Use a sterile device. Make sure your two-factor is not based on your phone. Don't tell people. Use a time vault. And I think that we can add a lot of value to our clients and to anyone that's dealing in cryptocurrency by just sharing some of these best practices with them. And then hacking insurance, it's a real thing. It's something that we have been utilizing for years at Sarson Funds. It's cyber theft and hacking insurance, and it basically will protect you not from an investment loss, but will protect you from someone breaking onto your computer and stealing your password and getting into your account, or stealing your private key and downloading your wallet and stealing your funds, because they basically have stolen your data, and your data had access to money. Now, when you look at these policies, you'll want to like pull the policy up on your screen. You'll want to do a search feature for the word cryptocurrency. Make sure it's not specifically excluded from the policy you're looking at. Typically, there's no exclusions at this point for cryptocurrencies, but I haven't looked in the last couple of months, so that may be changing quickly. But hacking insurance is pretty inexpensive. It runs about $1,000 per million. So it is something that's maybe worth getting if you think you could potentially be a victim of cyber theft. These companies will be happy to underwrite that type of insurance.
All right. Well, I hope you guys have enjoyed this session. We encourage, if you have, we got another minute or two before we take Q&A. If you have some additional questions, please put them in the chat. I know I saw a few questions pop up in there, but we covered a variety of different topics today. A lot of them seem like common sense, but hopefully this also reinforced some of these, security best practices. Especially as you start, the cryptocurrency. Obviously, the markets are starting to move. And people are going to be excited. People are going to be talking, whether it's your friends, your family, yourself, your clients. This is a good time to have that reminder conversation. This is a good time to review your own personal security protocols. This is a great time to order one of these security devices, like a YubiKey, right? At $50, go to Amazon or go right to Yubico's website. YubiCo is the firm that makes it, and get familiar. Start to use it. Start to advocate it. You'll be looked to as an expert, not because you talked about a particular crypto that's doing well. You'll be looked to as an expert because you talk to people about how to do it safely. And that, especially at a time where it seems like we're in a bull market, you were the one that remarked on, this is how to do this correctly, and this is how to protect yourself. This is a way to really gain authority even in this emergent space. So we make sure that at the end of this presentation that everybody will get a copy of this presentation. And also, too, John and I, our emails will be available. If you have any follow-up questions you didn't think of during our session today, feel free to reach out to us. We're always happy to respond to the questions that we get after our sessions. And I think with that, Dara, that brings us up to the 50-minute mark. And John, if you have anything else that you want to opine on, and then we can get
I'll just kind of give a very high-level thought. If ever there was a time in an asset class where some active management and some professional assistance might be worth its price, it's when an asset class is still in an infancy stage and the investor protections have not yet been established, and it's in the throes of price discovery. So we gave you some of the ideas that we do at Sarson Funds to make things safer. U.S. exchanges, large cap coins, multiple sterile devices, diversified portfolios. But it might be a really excellent time to look at an active manager. just because to go it alone as an amateur is a recipe, we think, for potential problems. And so we give that advice to people that, like, maybe this is a time to splurge on active management. Hi, Dara.
Hey, so this was so great, guys. I really appreciate this. And we do have a bunch of questions, so I'm just going to start rolling them out. There were a couple of questions and discussion about Ripple, where we could purchase Ripple, what exchanges, etc. So you want to weigh in on that?
Sure. We don't buy Ripple as a firm because of the SEC lawsuit that's unresolved. So we don't know where to buy it, I guess. But there are many exchanges that you can buy it on. Not many U.S. exchanges, though.
And Jahan, you had mentioned Arculus, and we have a question here: is Trezor sort of like an Arculus, or is it different in what it does and in what way?
So there's a lot of similarities between Trezor and Arculus, similar to like the Nano Ledger X. It's a cold storage wallet option. However, Arculus is built into a credit card format and also has an app that coincides with it. So it can be seen, it is seen by some folks as a bit more transactional friendly, and next level up in terms of its authentication capabilities, where Arculus is a 3-factor authentication. And there's a lot of folks that have high hopes for it because it's a bit easier to get folks to adopt to a credit card style transactional capability and storage capability than it is for a thumb drive or a new looking type of device, if you want to look at it from a real world adoption perspective. But there's a bit of overlap in the problem that they're solving.
To just put a little more color to that, like, if you choose to not leave cryptocurrencies on the exchange, then you choose to take them off the exchange. And once they're off the exchange, they can reside in your browser in a MetaMask wallet, which is not a safe option. A better option than on your browser for anyone that gets on your computer to have access to your cryptocurrency balances would be a cold storage device such as a Trezor or a Ledger or an Arculus wallet. Those are all better cold storage solutions than printing it out on a piece of paper or putting it on a pen drive, or leaving it in your hot wallet on your browser. So those are reasonably good hardware devices. All three of them really check off a lot of important boxes, but that's only really for coins that you choose to take off exchange.
And John, you spoke before about technical analysis, and I thought that was a great quote. Also, how you compared commodities and how cryptocurrencies respond well to technical analysis, like commodities, and trade like that. What type of technical analysis, are there certain websites or tools that you recommend that people could go to start getting involved in that and start doing their own technical analysis?
Yes, TradingView is a really great site for technical analysis on cryptocurrencies. TradingView. The number one place to start your research for cryptocurrencies is CoinMarketCap, CAP. That's like the Bloomberg of cryptocurrencies for retail investors. It has like every cryptocurrency that's been launched. It has a summary of what they do. It has a chart. It shows what exchanges you can buy the cryptocurrencies on. So CoinMarketCap as a starting place. And from the CoinMarketCap chart, actually, you can open up a TradingView chart to do technical analysis.
Oh, that's great. That's helpful. We also have another question coming in. If you could elaborate on why you don't recommend taking coins offline to the cold storage.
So you have to ask yourself, what am I trying to achieve by taking this coin off of line? Like, I think that most of the time you're going to probably try to answer this feeling that, like, well, I don't really control my cryptocurrencies if it's on the exchange, because the exchange is holding it for me. And to that, I would say, do you take all of your stocks off of Merrill Lynch and get the certificates sent to you? Because it's the exact same thing as taking your coins off of Coinbase. No doubt, if Merrill Lynch were to have a giant conspiracy where they were to steal everyone's, as a custodian, and steal everyone's stocks, like, that would be problematic, and you would have been a genius for taking your certificates and putting them in a safety deposit box. I just don't see that happening at these big exchanges that are so valuable and backed by some of the most well-respected financial institutions in the world.
That's a good analogy. Okay, we have another question. What about making payments? On what device would we keep our money that would be the safest for future retail and or online purchases?
I know it's impossible to say that you should do that on a sterile device for making payments. And I personally use my personal phone for making payments through my Coinbase app. But I do have my hard token associated with my Coinbase app, so I can't send a payment without using my third part of my third factor identification process. So you can add many of these different hard token layers on top of your retail payment apps to make them secure in case my phone were to get lost or compromised. Someone still wouldn't have my hard token in order to make that payment to themselves and steal my money.
And just John and I are also personally both fans of this, which is the Coinbase debit card, which you can tie into your Coinbase account and use USDC for online purchases or in retail purchases. So
4% cash back.
Yeah, and you get cash back in crypto.
Yeah, in Stellar. And we like Stellar. We like Stellar because Stellar, along with Algorand, Solana, Hedera, and Ethereum, are one of only 5 places that Circle, the largest crypto bank in the United States, that's a joint venture between Coinbase, Fidelity, Goldman Sachs, and BlackRock, issue USDC on. USDC is going to be the most important cryptocurrency in the country in a year. It is a stable coin. It tracks the US dollar. It's a digital version of the US dollar, but it's better than the US dollar. And the reason why it's better is because it moves on crypto rails. And it can go quickly to anyone you want it to go to. And if it goes to the wrong place, Circle can turn it off and they can reissue it. It's better than a wire. You send a wire to the wrong place, it's quite hard to get it back. You send USDC to the wrong place, Circle can turn it off and they can reissue it. It is centralized. Some people hate that, but we all work within finance. And we've already agreed that we believe that our government is not corrupt and that we believe that financial institutions are here to serve us. And USDC is a really important product that's issued by Circle. And Circle is issued on 5 different layer 1 protocols: Stellar, Solana, Ethereum, Hedera, and Algorand. And we own all 5 of those investments at Sarson funds.
Wow, interesting. And in the beginning too, John, you had mentioned, you were talking about the different crypto exchanges, and you had said something about some of the tax consequences are different on some of the different exchanges. Could you elaborate on that a bit?
Sure. So taxes are a question we get all the time. Question, do you think the IRS is going to be able to see this transaction? And my answer is always the same. Maybe not today, but soon, and for the rest of your life. So you want to be cognizant about whether or not you want to think, oh, the IRS didn't notice this transaction, because the software that the IRS is implementing to track cryptocurrency gains is arguably better than the software that you're using as a retail investor to track your cryptocurrency gains. And these cryptocurrency transactions being on a public ledger are infinitely sortable and indexable. And that transaction that right now is happening on an exchange that you've never disclosed, but later on is going to go to another account you never disclosed, and later on is going to be used to buy Propecia from Canadian Pharmacy and sent to your house, and the IRS's software is going to say, boom, it's yours. And you don't want to be on the wrong side of that conversation. So we highly recommend everyone download a tax software like Coin Tracker that I use personally, and or leave your cryptocurrency allocation to a professional that'll do your taxes for you. But certainly pay your taxes on cryptocurrency transactions. Do not avoid them. You will live to regret any avoidance of cryptocurrency taxes, in my opinion.
Wow, that's great advice. Well, gentlemen, I think this was a phenomenal presentation. I really appreciate the great insights and education. And do we have another one? One more question we could do, and then we'll wrap it up. How does an RIA work with Sarson Funds on behalf of its clients?
Thanks for that question. That's a great question. We love working with RIAs. We can choose to either reimburse an RIA a portion of our revenue. If you want to put that into your ADV, then that's one of the ways you receive revenue. We'll do a revenue share with you. Or if you want to just refer clients to Sarson Funds, we'll lower our management fee by 1% to make sure that the clients don't pay anything additional to come through a referral from you than they would have paid if they came to us directly.
Yeah, and
That's
we have
great.
there's a suite of products too that all have a different flavor. So we encourage you to go to sarsonfunds.com and you can take a look at the product set that you feel might work best for your client.
Yeah, we try to help you manage risk. We have a large coin product, a small coin product, a crypto and income product, for example. So you can really build a bespoke portfolio of cryptocurrency for your clients.
Great. And one final question: can you handle our IRAs?
Yes, we do. We handle IRAs, but we do not handle ERISA money. So no SEPA IRAs, but traditional IRAs and Roth IRAs, yes.
Excellent. Well, with that, gentlemen, thank you very much. This was fantastic, as always. And for everybody listening, I really thank you all for tuning in and taking the time to share the afternoon with us and for all your questions and great insights. We will be sending a follow-up email to you with information on the next sessions, and there will be a recording available, and you'll be able to download slides as well, and you'll get a whole bunch of information from an email, in an email later on, probably either this evening or tomorrow with further details.
All right. Well, thank you very much, everybody. John, thanks for coming on today. Dara, thank you for hosting, and thank you for the D-Wealth folks. We have had such a great time with these sessions. Thank you to everybody that's come on board. You'll be getting some additional emails over the next couple of weeks here that are going to finalize some of the details about the NFT certification. But keep an eye out for the follow-up to this presentation, as well as the recordings. If you missed the previous ones, are available online, and you'll get links to those too. So we hope everyone has a great afternoon.
Thanks, everyone.
Thanks so much.
Bye-bye.